Hi, I'm Pattu from freefincal. Today, I want to talk about reasonable risks and unreasonable risks in investing. A reasonable risk means that if an event occurs, let's say 10 times, or if 10 people participate in something, um, most of the time that uh, there's a victory or most people tend to win. That is, let's say more than 50%, 60, 70% of the time, there is a chance of success, then it is a reasonable risk. An unreasonable risk is just the opposite of that. Um, the chances of failure are more than 50%, or the chances of success are less than 50%. So, for example, SEBI has released 2 or 3 research reports on trading, and they have shown that in the futures and options segment, 9 out of 10 people lose money. And in the intraday trading segment, 7 out of 10 people lose money. And there are much more insights on that. I have compiled many of those results into an article. I will leave the description, leave it in the description. So those are clearly unreasonable risks. Most people tend to fail, and you can't say I will be the one who succeeds. That's just not convincing enough. I think we need to respect our money more, and our time even more than our money, and our health even more. So considering all that, it makes no sense to do F&O. It makes no sense to do intraday trading. I once mentioned this in a talk I gave, and that was edited out, probably because by someone else who published it, but that was kind of edited out. I don't know why. Well, anyway, so but I recently got a chance to say it again in another forum, so I want to say it again now in uh, in uh, in the freefincal channel. So that's obvious that you shouldn't do it. And investing in active funds has almost become an I would say an unreasonable risk, because most funds fail to beat the index, and you don't know which fund is going to do well in future. So it's definitely an unreasonable risk. I think there is a recent data about SIPs doing well, long-term SIPs in active funds doing well. Uh, Taking a 5-year SIP or a 7-year SIP or 10-year SIP is still um, just a trailing return. It's still from point to point. So you still need to do rolling SIPs and rolling lump sum. There's not much of a difference between rolling lump sum data, which is available. I have done that several times, and rolling SIP. But for what it's worth, I would like to publish very shortly a rolling SIP calculation between the fund and the index. Let's see what it gives. Let's have an open mind and let's see what it gives. So, so that those are all unreasonable risks. So investing in an active funds is fast becoming an unreasonable risk. But on the other hand, if you say investing in equity is gambling, there are many people who still say that. A lot of equity. They say they'll just had a small equity, or during a bull run, they'll say they will invest, and during a bear market, they'll say they won't. Uh, that is not an unreasonable risk. It's a very reasonable risk, because long-term data, forget the Indian market. The Indian market data is only 45 years old. Taking long-term data, 106-year data, 110-year data using the US market, we know that most of the time, um, equity tends to beat inflation. Therefore, it is a reasonable expectation to invest in equity over the long term, not trade, invest in equity over the long term, and expect equity markets to give a return greater than inflation. However, you cannot expect too much return and expect equity to match that. You can't say, I will expect 15% returns in the future because the last 15 years have given me 15%. The market has no such obligations to meet your expectations. Then it will be a failure. If you expect 15% return, but you only get 10% or 9%, equity would have still bet inflation, but it would have not bet your expectation. Therefore, it would still be a failure for you. It will be a personal failure for you. So you have to be a little careful in planning that. So it in life also, there are very clearly reasonable risks and unreasonable risks. For example, making a career jump early in life is a very reasonable risk. You are young, you're not married, you don't have children. This is the time to follow your passion. This is the time to take career risks. You can't do that 10 years later or even 5 years later for some people. So that's a reasonable risk to take. You can take that, following your passion, quitting your job. doing a creating a startup, etc., those kind of things earlier in life. Later in life, it becomes, it leans on an unreasonable risk. Taking care of our health, smoking and drinking are clearly unreasonable risk. We have huge amounts of evidence that they are going to cause harm to us, and yet many of us do it. And so we have to appreciate risk, and we have to evaluate whether the risk is reasonable or unreasonable. And if it is an unreasonable risk, it's a definite avoid. If it is a reasonable risk, we can we can typically embrace it, provided we understand the risks and we have a plan to handle the risk and how to manage the risk, like I've talked about in several videos before. Take care.